Welcome to episode 16 of Squashing the Market with Bill Ullman. Listeners to this podcast are in for a special treat. I have the great pleasure of welcoming one of America's leading voices on personal finance, the one and only Jean Chatzky. Jean is the CEO and co-founder of HerMoney, is the financial editor of NBC's Today Show, is the best-selling author of 11 books, and an award-winning magazine columnist, and the host of the HerMoney podcast. She's appeared on many television shows, including Oprah, MSNBC, CNN, The View, and The Talk. We will have to ask her if she ever has time to sleep. Through her decades of reporting on personal finance, Jean has developed a keen understanding of the financial industry and the media business. She has built a huge following by taking complex financial issues and making them understandable for ordinary Americans. Through HerMoney Media, Jean has become particularly well known for helping women work through their unique financial issues. You can follow Jean at the HerMoney website or at Jean Chatzky on Twitter. Welcome to Squashing the Market, Jean Chatzky.
Thanks, Bill. Thank you so much for inviting me to be here.
It's great to have you aboard. Let's start with your beginnings, your transition into the financial world. How does a college English major become a leading voice in personal finance?
I think I was in the right place at the right time. And I was interested. I mean, that's the truth. I was interested in personal finance. And I think I knew that my personal finances needed a lot of fixing. I graduated from college in 1986. I wanted to be a journalist. I got a job at a magazine called Working Woman that doesn't exist anymore, but it was an interesting magazine in that it was kind of a weird combo of food and fashion and finance and careers and business. And my job was as the editorial assistant to the business editor, which meant that not only did I get to answer her phone and run her errands and that sort of stuff, I got to write stories about business. And I got to write some stories about personal finance and careers and marketing, and I liked it. And so when I was ready to leave Working Woman, I looked for a job at a business magazine, and I could not get one. The business magazines thought Working Woman was a joke and that I didn't have the chops to write these stories. And by the way, they were right. So I floundered for a little while. I freelanced for some time. And I don't know, somewhere along the way, I just started to think about business journalists and what they do. And every time I had written a story about a company like The Gap or Nike, I would pick up the phone and I would call equity research analysts on Wall Street and ask them about the company, and they had all the knowledge. And I thought, well, I know research analysts write a lot of reports. Maybe they would like to have someone there to write their reports, and maybe I could learn about business on the way. So I did that, and I found it relatively easy to get that job. I did it for a few years. I assisted 3 different healthcare analysts at Dean Witter and learned a lot. Learned how to read a balance sheet, learned how to analyze financial statements, learned how to talk to corporate leaders. And then when I was ready to reapply to journalism, I got a job at Forbes, and they were pretty happy to have me at that point where they wouldn't look at me before. From there, I worked my way up. I found my way from Forbes to Smart Money, got put on television along the way, and really learned by reporting. I mean, my job as I see it is that I get to call up the smartest people in the world on mortgages or credit cards or behavioral finance or investing and ask all the questions, every single one that I need to know. And then I get to digest that information and present it in a way that is understandable. But I get to ask all of the questions first, and that helped me fix my own finances along the way.
Dating myself, I remember Smart Money magazine. That was a really good publication. How did you think about making that transition, though, from writing about companies to writing about personal finance, savings, mortgages, credit cards, et cetera?
To say think about it is giving me way too much credit. When I went to Forbes, I was a fact checker. That's what reporters at Forbes do when they're baby reporters. You follow in the footsteps of other reporters and you basically check their stories without reading back quotes. So it's really good training for reporters because you just get to re-report the story and ask all the questions to elicit the information. But it's not as fun as writing your own story. And so I had been at Forbes for about a year, a little more than a year. I was starting to write some of my own stories, and some of the people that I had freelanced for in the past were on the startup team at Smart Money. They needed writers. I was able to make the jump from being a fact checker to being a real writer. And so I took that leap. And along the way was joining a personal finance magazine. I mean, that was part of the job. And I definitely thought twice about it. At Forbes at that point, personal finances were a backwater. I mean, I was definitely doing well at Forbes, and I had a slew of people come into my cubicle to tell me they thought I was making a huge mistake by going to this personal finance magazine where my life was going to be just one 12B1 fee after another. And I went back. I had accepted the job. This is really bad form. People should never do this. But I had accepted the job, and these naysayers got to me. And so I went back to the guy who had made me the offer, who would soon be my boss, a guy named Steve Schwartz. He is now CEO of the Hearst Corporation. And I said, I don't know if I can come work for you. I don't want to write about the minutia of mutual funds. I want to write about people. And he said, you can write about all the people you want. You never have to write about mutual funds. You just come to me with good enough story ideas for me to greenlight them, and we'll be just fine. And so I went, and it turned out to be the best job I ever had. I mean, working on a startup is something that everybody should do. It's great to know that you're in a place where you can throw spaghetti at a wall and people think that it's really good and will try all of your crazy ideas. And it was great. I was employee number 5. I was there for about 5 years. And it was while I was there that I got started on television because we had a very aggressive PR effort, and they put all of us on television. And I was just kind of the one who stuck.
It's fantastic. There's so much to unpack in there. Number one, earning your way into this financial journalism job where you knew you kind of didn't have it when they first turned you down, when Forbes said, no way, you're not qualified to write here. You paid your dues doing research on companies, writing reports, editing reports, et cetera. But then also, this is the old media world, right? Like this is print and TV, which today are considered passé because it's all about digital streaming, social media, TikTok. Let's talk about that for a second. What's changed in the media world you've had such a good window on it for many years now. What does the media world get right and wrong about covering personal finance?
What's changed is, two things have changed. One is that people realize the importance of personal finance in a way they didn't when I was just starting. And that I really attribute to the demise of pensions and the coming of 401ks, right? When you had a pension and your company was going to take care of your retirement, you didn't have to care. You didn't have to really manage your own money except for staying on budget. And people did know how to do that, for better or for worse. But when 401ks came into their own and when they started to gain in popularity, all of a sudden personal finance became important. And Smart Money timed that very well. The sort of rise of the individual investor empowered by these 401ks. To your question more directly, the second big change has just been a democratization in the availability and variety of voices in the space. Everybody can have a microphone these days if they want it. Everybody can have a TikTok channel. I mean, yes, you got to put some work into it. You have to be valid enough that people will listen to you. But you want to put a message out there, you can put it out there. Whether it sticks or not is sort of up to the universe and up to your marketing and up to your gimmick and up to the quality of your information. I mean, for me, I was the voice on personal finance for 25 years. I haven't been doing it for a couple of years at the morning show that had the greatest viewership on the planet for a very, very long time. And that gave me a huge microphone and a huge opportunity. I think these days, the up and coming voices and people like me who want to stay relevant, we have to hustle a little bit harder.
Yeah. And when you had that megaphone, if you will, and talking to so many people, were you ever intimidated? Did you ever worry about, oh, that's a topic, I have to talk about it, but I'm not really sure I'm giving the right advice? Or
yes and no. So I'm a reporter, right? I'm a reporter. I'm well sourced. I am going to do my homework before I talk about anything. So in terms of giving the wrong advice, I wasn't as worried about that in most cases as I was nervous. I mean, in general, when I started giving this sort of information and giving this sort of advice, I was nervous to be on such a big stage. But I learned pretty early on that you shouldn't bluff it. There are some things in personal finance where you can have answers and you know those answers are correct, right? What is the best credit card? I can do the research on that. I can find the one with the lowest rate. I can find the one with the highest rewards. I can find the one that is letting the most people into the program. What's the best deal on a term life insurance policy? But there are so many other questions where the answers are either right-ish or there are trade-offs and you have to explain the qualifiers for a specific group of people. Should you buy term insurance or permanent life insurance? Well, it depends, right?
Right.
And then there's that whole other category where the answer is we don't know. We can take our best guess based on what history is telling us. Where are interest rates going? Where's the market going? All of those questions I can answer for you based on history. I can give you the facts based on history. Can I be right? No. I'm not going to guarantee that I can be right. I'm going to tell you what I know based on the evidence, and you're going to have to take it from there.
I've often thought our financial lives are journeys. We move through these different stages in our financial life. We encounter different problems as we go along in life. What are your thoughts on some of the key stages we all have to confront, and what should we be thinking about as we prepare for those different moments?
Oh, there's so many, right? Your friend and my friend, Rob Denson, he calls these inflection points. And I think that's a very good, nice term for them. They're reflection points. They are the things that cause people to actually seek financial advice. People don't tend to come for financial advice just because. They come for financial advice because something happens, because they hit a stage, because they have a problem. Getting out of college and getting started is one. Getting married or partnering up, having a child, getting divorced, losing a spouse, getting a job, losing a job, turning 40, turning 50, turning 60, like all of those big birthdays are milestones that force people to start to look for counsel. And they should. I mean, I think when we don't stop to reflect, we blow opportunities. When we don't stop to think about the boxes that we should check when we're getting into that first job in terms of making sure that we're maxing out the benefits that we're offered, we miss big opportunities. When we make emotional decisions about money in the throes of some sort of a crisis, whether it's losing somebody or getting a divorce or some other crisis, we make mistakes. And so, just pausing and thinking and being as rational as possible in those moments is really important, and getting help if we feel like we don't have the faculty to do it ourselves.
And that comes back to the media a little bit, because I think people do seek out help at these moments. But as you said today, social media is as big a part of our lives as traditional media. And so how is the average person supposed to make sense of all the information and misinformation that's out there? Because you could go off the rails if you listen to some people. You could be too conservative, frankly, if you listen to others. There's, as you know, there's There's different pathways to financial success and happiness. What advice do you give people today when they're, let's say, turning 50? I need to re-examine everything, my savings, or is that in the right position for me to be able to retire in 10 years or whatever? Where do people go?
Well, I'm a big believer in planning about 10 years out from retirement if you haven't done it already. I think that is the appropriate time to sit down with a financial advisor if you haven't done it. And many people will have done it before, but you are about to exit one very, very large challenge and enter another, right? You've been told forever that you just have to accumulate money. You have to save it, you have to invest it, you have to make more of it. And that will continue for another 10, 15, maybe even 20 years at 50. But then you got to take it and you have to make it last for the rest of your life. And that is a challenge that is equally difficult. And you need a plan. You need a plan that shows you numbers on paper, that shows you if you spend at a certain rate, this is what's likely to happen. If you spend at a different rate, this is what's likely to happen. If you invest like this is what's likely to happen. If you take Social Security at 62 versus 70, you need to see it all. And that requires help, I think, from somebody who looks at these sorts of things every day. And so I think that's a very good time to go out and find a financial advisor. Now, that said, there are other times in your life where maybe all you need is some financial advice. And that's different, right? Financial advice is something that you may be able to get by reading a column in the Wall Street Journal. You may be able to get it by listening to a podcast or by watching a certain television show or reading a particular newsletter. I think you should pick your sources. There's so much information. There are that you're right. Your head is going to spin around and pop off if you're trying to pay attention to everything, and you're going to get caught up in feeling that you made bad decisions because other people are disagreeing them. Pick a couple of people that you've read long enough or you've followed long enough so that you believe that they're rational and you want to continue to listen to them. Back when I was a puppy reporter at Forbes, I had the good fortune to work with Jason Zweig, who was covering mutual funds then. I read him every single time he writes. I think he always has good advice. I know where he's coming from. His level of wanting to take risk lines up nicely with my level. So he's a good fit for me. And there are a couple of others that I just sort of turn to routinely. Find your rabbis and then listen to them. And when your rabbis are no longer working for you, then find some new rabbis.
In addition to being a financial journalist, you're an entrepreneur. You started a company called HerMoney Media, and it's a company focused on helping women, financially speaking. Talk to us how this came about, how you came up with the idea, the funding, the whole startup process. Now you're a sort of startup too. Has anything surprised you about running your own business? What's been easier than you thought? What's been more difficult? Let's go through that. We talk to a lot of entrepreneurs on this podcast, and you fit squarely into that as well.
So I started HerMoney. I started the podcast HerMoney before I started the company. I was fortunate enough. I had to sit down with some of the folks that I was working with at Fidelity Investments. They said, what else could we do together? I said, how about a podcast? They said, sure, we'll sponsor that. And so we launched a podcast. About 3 years in, I had the opportunity to buy the assets of a company that I had once written for called Daily Worth. I had been thinking, along with my podcast producer at the time, Kelly Hultgren, of making HerMoney a destination, making it a website, making it a company that produced content and newsletters and a bigger platform. Acquiring the assets of Daily Worth gave us a jumpstart. It was a company that focused on the women's space. It had a good list. It had a good library of content. And so that gave me a running start. I got to tell you, the hardest thing is people. People are hard. And especially when you're small, people are hard. It's not that finding them is hard, which it is. It's just when you're a small company, every hire has the weight of the world sitting on its shoulders. At least that's how it feels to me. And you don't want to make a mistake. You want to make sure you're respecting your mix and bringing your culture along in the way that it has grown to that point. That's been the hardest thing for me. But there have been some tremendous surprises along the way too. We formed a partnership with a company called WealthRamp that is a matching service for financial advisors. And that has been a nice channel for us to explore. We've been able to develop a continuum for our community. So they will often go into the coaching classes that we have started. We've started a program called Finance Fix, where we help people with the challenge of getting their budget under control and making sure they have enough to save so that then they have enough to invest, so that then they have enough to build a future. They go from our Finance Fix classes often into a course called Fix Plus, which is a little bit more advanced. We're developing a course for investors, so that'll be another layer. But then often when they graduate, or even when they're still with us, they want a financial advisor of their own. And now we can help them make a match with a financial advisor who is a fiduciary, who's been personally vetted by my partner at WealthRamp. And so I've liked developing the products. That's been fun for me.
So women live longer than men on average.
Yes.
And over the next 20 years, there'll be an enormous transfer of wealth during this period of time. Often women have estates to deal with at that point. What are the unique problems faced by women versus, say, men? What do women need to pay particularly close attention to in their financial lives?
Well, so you just hit on the demographic factors that are big for women, right? We outlive our partners. We are still earning less when it comes to traditional wages. As the pandemic has pointed out in no small way, we're still the ones who are the caregivers. If somebody needs to take a break from the workforce, more times than not, it's going to be the woman. As a result, we get to retirement, we have a smaller nest egg, and then we need to make it last a longer period of time. That presents a challenge. And it means that we really have to step up and embrace our inner investor. And women are more so than men reluctant to do that. We leave more of our assets sitting in cash. And that's a problem, because if we don't put this money to work, we're not going to be able to sustain ourselves in the way that we would be if we were putting it to work. So we've got to wrap our arms around the challenge and get ourselves in. It's not that women are not good investors. When we get started, we're actually great investors statistically, because we don't trade as often as men. We actually perform better than men. But that getting started piece is often harder, I think, because we like to know the answer to every question before we ask it. We like absolutes. We like knowing that we've gotten all the education. And as you and I were talking before, that's often not possible.
Is there something in our education system, in the way we raise daughters versus sons, that women aren't gravitating towards investing or having this investing trait?
Well, there is. I don't know how much of it is nature versus nurture. I don't have enough research to say it's one or the other, but there are differences. T. Rowe Price every year, or every other year, I think at this point, does a big parents, kids, and money survey. And their findings year after year point to the differences in how we treat our daughters to how we treat our sons. And we talk to our sons more about things like, we're saving for college for you. This is what a credit card looks like. We bring our sons along in a way that we don't bring our daughters along, and we need to do better in that aspect. I think there's some nature involved as well. When I wrote my last book on women with money, I asked hundreds of women, what do you want from your money? And before they got to the tangibles, almost to a one, it was safety and security and savings and stability. And when you look at how women go through the world, right? When you look at the fact that women are just not as safe walking home at night in their own neighborhoods, you understand where that came from. But there are financial repercussions. I do think in this arena, part of getting to the point where we're investing more is accepting the fact that through our 401ks at work, we're already investing. We just don't feel like we're investing. We're already doing it. We're probably already doing a pretty good job of it. We just need to understand it and own it a little bit more. And that, I think, can help propel us forward. It's why we're developing this investing course, because the women in our private Facebook group, and we have this amazing private Facebook group at HerMoney. There's 17,000 women in it. They help each other through all of their financial challenges. Anybody who's listening who wants to join can absolutely join. It's been remarkable to me to watch this group just form, but they're constantly asking for more on investing. And so we're working on this program to give it to them.
Let's shift gears. I do this with all my guests. We talk a little bit about their own financial journey and how they approach investing for themselves. So let's start with you. Are you a do-it-yourselfer, or do you have advisors helping you out? And can you talk about your retirement portfolio in kind of general terms, not specific names of investments, but is it stocks? Is it bonds? Is it real estate? Is it funds? Is it alternative investments? Is it crypto? How do you think about putting together a portfolio for yourself for your retirement years, which aren't coming up anytime soon because you're so busy, but how do you think about that?
So I have a financial advisor. I've had a financial advisor for years with an assets under management model. I am involved in the decisions when there is a bond that rolls over and we got to reinvest it. We'll have a discussion about it. My portfolio is about 50-50 at this point, which is a little conservative for somebody my age, but I got divorced at 40. I started saving like a crazy person. I'm a little risk averse, and I know that about myself. And so I compensate by saving more. I have other investments. I take risks with investments in startups. I've done some angel investing. I have invested in a number of startups through the years. I actually really enjoy that, but that part of my portfolio is money that I could afford to lose. It would not have an impact on my retirement. And
I assume that would be kind of less than 10%, maybe even less than 5% of your overall number.
Yeah, it's less than 5% of my overall number, and it's fun. I mean, much as I enjoyed being a research analyst for those couple of years, I enjoy learning about these companies. I think it helps me understand my own company a little bit better, to watch these other companies go through their funding cycles and learn about their businesses. I keep a small account at Fidelity where I buy individual stocks that I have talked to somebody about, because I come along, maybe I get an idea for something from my podcast or whatever, and I want to buy it. That's where I go ahead and I do that.
We couldn't possibly do a podcast with a financial services expert without talking about crypto for at least a moment. What are your thoughts on cryptocurrencies, Bitcoin, NFTs, the blockchain? Do you have any thoughts about that? Is this something that's part of your portfolio, or is it, stay away?
No, I'm not a stay away. In fact, I've been watching it because I actually think that I'm going to take a small position. But again, with that same 5%, with that money that I could afford to lose at this point, I'm thinking this is probably here to stay. This is still incredibly risky, but it seems to be gaining acceptance. It seems to be, it doesn't, maybe it seemed like a flash in the pan 5-10 years ago. It doesn't seem like that anymore to me. I read Jamie Dimon went on the record today and said that Bitcoin could be 5 times its value. I think that's what he said, in the next 5 years.
Big change.
Yeah. He said it could, but he doesn't care. He doesn't he's not interested. I'm interested. So I think when you're interested, having a little money at work is a way to stay interested.
You mentioned Jason Zweig before as one of your go-to authorities. Who do you view as your financial role models out there? Who do you aspire to be like? Who do you follow closely? Who else, I should say, do you follow closely? It could be for information, or it could just be that they're a great investor or a great person, but who are your role models?
Oh man, there are so many. So I've been spending a lot of time with Karen Feinerman lately. You'll see her on CNBC's Fast Money. She's working on this investing product with me, and she's a hedge fund manager. She's an investor for a living. We could not be coming at this from a more different perspective, but I'm learning a lot from her, and I like the way that she approaches her investments. There's a real discipline there that I think a lot of us could truly benefit from. So I like what she's got going on. I consume a lot of media. So I feel like I read most of the financial journalists who are out there. Michelle Singletary always has something interesting to say in the Washington Post. I love reading David Leonhardt in the New York Times. I think his take on economics is fascinating. And I pay a lot of attention to behavioral economists. I think that we often do not understand how to protect us from ourselves, especially when the markets get hot and heavy on particular days. We have to be really, really careful that we don't let our emotions get the better of us. But even when it comes to things like how to save more, how to get yourself to protect yourself in the right way, these economists who have a background in psychology have an awful lot to teach us. So I read a lot of them as well.
It's fantastic. Jean, this has been a great discussion. I always end my podcasts on what I call my lightning round, where I just give you pairs of words, a choice. You just have to pick one, and you don't have to say why, though. And there's no right or wrong answers. So here we go.
Scary.
Very scary, very scary. Stocks or bonds?
Stocks.
Liberal arts or STEM studies?
STEM.
Government regulation or buyer beware?
Buyer beware.
High salary or large stock options grant?
High salary.
401k deposit or once in a lifetime journey? Tough one, right?
This is hard. This is so hard because you didn't say how big that 401k deposit is. 401k deposit.
Student debt or credit card debt?
Student debt.
Actively managed mutual funds or passively managed ETFs?
ETF.
Cryptocurrencies or gold?
Crypto.
Jean Chatzky, it has been an absolute pleasure talking with you today. Thank you for joining the Squashing the Market podcast.
Thanks for having me.